Mayuresh, thanks for taking the time out. We're talking about this big story today and the resultant impact, Mayuresh, that this has had maybe on some non-Reliance media properties, but also on the Network 18, TV 18 twins as well. What have you made of this development for some of the entities that are reacting to this deal?
Afternoon, Neeraj. No, so two aspects here. One, obviously, in terms of the synergies that come through, both in terms of content, in terms of the boutique and the wide array of channels that now are at the behest of Reliance, once all the formalities are done. I think there is going to be a significant market share gain when it comes to the digital viewership as well as the cable viewership for Reliance through this entity. The second element also is that if you go by sheer revenues, now the merged entity will have revenues in excess of 24,000 crores. And you compare the second or the third player behind this, Z does revenues of around 7,500 crores, Sun TV does revenues of 3,500 crores. So I think the kind of revenue gap that will start coming through is going to be very, very obvious. And therefore, I think the other players within this entity group itself, for Reliance in particular, when you've got the other cable guys like Hathway and Den also under its umbrella, I think a lot more consolidation is expected to happen and synergies getting built up as well, both on the revenue and the cost side. Obviously, I think their competitors at this juncture, after the merger exercise is completed, Z is going through its own sweet problems as we speak. Sun has risen quite sharply over the last few months. And it's still attractively placed because they are trying to regain some of the lost momentum, specifically in the southern markets, both in terms of the direct channel subscription, in terms of subscription revenue, the film revenue as well, and the OTT part of the business area. They want to narrow out the losses as well. So I think the industry is going to be a highly consolidated one. But I think Reliance through this merger obviously is going to enjoy a lot more in terms of synergies coming through, both in terms of sports, movies, OTT, and the digital entertainment and rights as well.
Okay, thank you for that, Mayuresh, giving us a bit of an overview with regard to what's happening in media. But time for a quick break. Stick around. We'll speak how much you are able to hear, but some fairly confident commentary around revenues, but more importantly around the operational metrics and the order flows.
Yeah, Neeraj, I think the management sounds very, very confident. And the confident is emanating from the fact that input costs have started coming off quite significantly. So what I could take away was that the last 2 years, they were badly beaten down in terms of input cost inflation. And that clearly reflected on margins. If you look at the 22-23 numbers, as far as EBIT margins are concerned, low single-digit margins. And that's a very, very sharp recovery on the EBIT margin front and the EBITDA margins as well. Now, if operating leverage is assumed to be playing off in terms of more orders coming their way, they're executing it in a timely fashion, and input cost deflation in earnest starting to play out on the balance sheet. If those margins start coming through and get sustained over the next year or so, we've obviously seen a huge price run-up or a price action over the last few months. But as numbers will start coming through, my own sense is that the momentum on this stock can very well continue. But then at the end of the first half, as we head into the second half of the next financial year, we will again come back to setting up the base for numbers because it will then be on a high base that FY25 will start working at. How will margins play out? How will input costs play out? I think that will be a totally different story. So in my opinion, I think anybody riding the momentum can definitely ride it. Fresh investments obviously need to wait out on how the execution probably happens over the next few quarters.
The stocks have clearly reacted and retraced quite a bit of ground today. But something like this, if it were to happen, is there a further dampener for the stock prices?
I think that's a large unknown, Neeraj. And if this does get implemented, it obviously will have a hit in terms of how rates are probably charged. So the average revenue per operating bed obviously differs region to region. It obviously differs in terms of the niche therapies that are obviously offered by various hospitals. So whether it's cardiology, whether it's radiology, just as an example. And till what extent is robotics a part of your hospital revenue as well? Because robotic surgeries definitely have higher ARP OBs. So if a standardized rate does come through, obviously I think the impact in terms of incremental earnings growth will be there on their balance sheets. The second aspect also is in terms of the payer mix itself, because this is very interesting to observe that a large part of hospital revenues and the payer mix that comes through is either from its own, from the patient's own pocket, either in terms of cash or check. And that trend is probably changing towards insurance as far as the payer mix is concerned. But if these regulations are implemented, yes, I think there will be some element of incremental hit that will come through. But I think it seems to be seen, because I think specialized niche surgeries obviously are very few and far apart, which very few hospitals can probably deliver at this point of time. And therefore, having a standardized rate in lieu of how the entire cost per bed structure is built out. If you probably look at the number of qualified doctors per 1,000 bed, India still ranks to be the lowest. And therefore, I think it's more important that the infrastructure probably deepens further. And therefore, I think if such hits probably normalize in such a scenario, what kind of an impact does it have on hospital revenues? Obviously, hospital revenues will take a hit. So diagnostic players, hospital ancillary stocks are a more preferred source of bets that we are looking at MarketSmith India, because there I think the expected revenue streams will still continue at a good pace. So I think diagnostics and hospital ancillaries preferred at MarketSmith more than the hospital stocks at this time.
Mayuresh, it's not always that it's the winner's gain. Sometimes an entry to the index has been a winner's curse too, and losers benefit as well. So what about Shriram Finance? What about UPL?
So again, as a disclaimer, we continue holding Shriram Finance in our portfolios. So clearly biased towards it. So as Harsh nicely mentioned, the diversification in its entire book itself is one of the key standing points compared to other NBFCs as we speak. And as they foray into different segments, housing finance being one of them, the kind of pedigree that they probably carry, and onto their book, I think most of the parameters that we discussed when it comes to NBFCs as a space, asset quality pressures have been coming off quite steadily because they enjoy a nice borrowing mix and their credit rating is also top notch. The kind of borrowing rates that they probably have ensure that their NIMs and spreads are also in the top quartile. Last but not least, in lieu of the RBI circulars, when it comes to unsecured stroke personal lending as well, it's a very minuscule portion of their overall book, and the management does not intend to grow it very, very aggressively, which brings us again to the basic aspect as a base case scenario, that as advances growth grows even significantly in a rate cut scenario at some point of time in the second half of this calendar or fiscal year, you're going to see significant accretion happening because their capital adequacy is relatively strong, very, very strong, in fact, compared to the rest of the players, which can give it that benefit and boost in terms of incremental credit deposit ratios being even higher as we head into the next couple of years. Therefore, giving support to both balance sheet and return ratios as well. So we remain biased, remain positive onto Shriram Finance. UPL, Neeraj, has clearly struggled, as have a lot of agrochemical companies in the aftermath in terms of the vagaries that you've probably seen in terms of how weather has behaved across continents. And therefore, the pricing pressures have played out in terms of top line. Input costs was largely to blame for the first half of the last financial year. Input costs have largely started stabilizing. But I think it needs to have a mix of both in terms of all key markets delivering in terms of volumes, reflecting in top line growth, better margins, creating that strong operating leverage that UPL has been clearly missing as far as bottom line and earnings growth is concerned. So between the two, obviously, I think as the indexation happens, more bias towards Shriram.
Let me quickly take it across. Mayuresh, any views with regard to JSW Infra? New listing, but the Jindal Group. So what's your sense?
So three interesting aspects happening here. One, in terms of the de-risking part, they are already at 36%. The management expects to take that to 40% outside their group. So as that happens over the next few months or years and quarters, I think that is going to be a huge positive as far as the mix is concerned. The second element in terms of the volumes itself at Jaigarh are expected to improve quite significantly. But two things they have done very, very interestingly. They've just taken over one of the port operations, which is around 100 nautical miles outside Bombay. They've got around 5 million tons of cargo that they can manage at this juncture, which can be easily expandable to 19 million tons. That was the optimism that the management put out in their earnings con call. And that facility is well supported by a railway line. So I think the evacuation that happens from the port facilities right into the logistics part, I think that is very well covered. And the management is also open in terms of container freight or ICDs that can come up later as well. And Fujairah, they have also bought out a 5 million space. And therefore, this entire corridor, as the trade probably expands, and the expansion in terms of expectations of volume-led revenue growth that will probably come through, with minimal amount of capex that is probably required for existing assets and assets that they've probably acquired. I think the margin profile should also start shifting gears more positively on the upside, creating huge possibilities as a base case scenario of net profitability actually improving over the next couple of years. The management sounded very, very optimistic, and going by management here, say they're able to deliver. I think this stock still has more legs to go.
Sure, Mayuresh, the other one in the port space has done very, very well as well. Adani Ports, if we can pull up the graph on that one. There you go, now trading at roughly 1300. This was sub 600 around a year back. Mayuresh, a preference between these two?
So both are equally good. If given a choice, Adani Ports has significantly moved, as we see at MarketSmith India, in terms of our key pivot levels. The EPS-RS rating has been exceptionally good. One of the few mechanized ports in Asia as we speak. The expectations in terms of container volume growth as the EXIM trade probably picks up steam from the next financial year as we come out of the crisis both in Europe and North America, and as trade normalizes also on the Western, in the Middle Eastern corridor and the Southeast Asian counterparts as well, with the China recovery as well. Container volumes globally are expected to move up quite significantly. And therefore, the expectations in terms of reasonable amount of growth getting reflected in terms of balance sheet numbers can be given, as I said, relatively higher placed in terms of pivot. So anybody holding on can hold on. Between the two, I think, as I said, JSW Infra has more triggers in terms of what they can deliver in terms of all the aspects that I spoke about. If they're able to do that very, very successfully and translate that into numbers in the next few quarters, I think some element of re-rating can come through JS Infra, and it's just trading above key pivot level as we speak. So I think both are equally good. JSW is an actionable as we speak. Adani Ports is a good.
Some news flashes on your screen. Cabinet has approved 3 more semiconductor units. All 3 units will start construction within the next 100 days. Tata Taiwan's Power Chip Semiconductor JV, Tata Semiconductor Assembly and Test Unit, and CG Power and Renesas Electronics Star Microelectronics JV. I think that's the other one. Wonder if CG Power is reacting at all to this piece of news. One can understand Tata Group, another thing, but CG Power certainly on some very thick volumes, by the way. 6.8 million shares traded, if I'm not wrong, has inched up a little bit. So watch out for this one too. Mayuresh, any thoughts here on something like this happening for CG Power?
I mean, if that happens, it's very, very interesting. And I think this is one space where the government intent is very well laid out in terms of accelerated investments expected to come through, so that the dependence in terms of both semiconductors and its end usage as far as applications in diverse industries are concerned probably get minimized. And therefore, I think if such news is to be believed, I think it is obviously positive. Also look out for Tube Investment, because that ultimately controls CG.
But Mayuresh Joshi, thank you so much for taking the time out and being with us today on the show and giving us your thoughts. Really appreciate your time.